Hello, welcome to AGN 3613. In this session, we will go over the concept of time value of money. We will define interest rate and look at some examples to understand the concept of interest. We will also define inflation and taxes, which will be addressed more in details in later chapters. In addition, we will learn how to use Excel as an interest calculator. Actually, you will be doing that yourself, but if you need any help, I will assist you. In the first chapter, we went over the principles of engineering economics, where we stated that a nearby dollar is worth more than a distant dollar. The change in the amount of money over a given time period is called the time value of money. To take the proper decision, we have to study the differences between alternatives. And when evaluating alternatives and taking economical decision, marginal revenue must exceed marginal cost. An additional risk is not taken without expected additional return. You don't risk your investment unless you know that there is additional return. And that's why, in the stock market, you have the high risk stock, you have the low risk stock, you have the medium risk. With high risk stock, the return will be more. One of the terms that you will hear and use a lot is the term interest or interest rate. Usually you hear this term when you are investing your money in some place, or when you are borrowing money from a financial institution. So what does the word interest means? It's the fee that will be paid either from someone using your money or from you using someone else's money. And usually it's expressed in percentage. So when investing, the interest will equal the value now minus the original amount. While when taking a loan, the interest will be total owed now minus the original amount. Let's take an example. You borrowed 10,000 for 1 full year, and you must pay back 10,700 at the end of that 1 year. Find the interest amount and the interest rate. To get the interest amount, which is uppercase I, we get the difference between what was originally borrowed and what needs to be paid back. So capital I, or interest amount, will equal 10,700 minus 10,000, which is in this case 700 for that 1 year. To find the interest rate, which is in this case the notation for it is lowercase I, it will equal 700 divided by 10,000. And in this case, the interest rate will be 7% per year. So let's look at some of the notations that we need to use in this course over the semester, during the semester. And one of the notations that we just said, which is the interest rate amount, and that will be uppercase I, and the interest rate which will be lowercase I, and that will be in percentage. So those are the two that already been introduced and we know them. The first one in dollar, it will be in dollar and it's the amount, and the second one in percentage, and that's the interest rate. Now we were talking about 1 year. What if we have multiple years? if we have multiple years, then we are talking about number of periods. The number of periods or number of years or number of weeks or months, its notation as N, capital N or uppercase N. The actual borrowed amount or the original amount, it's called the principal account. Notation for that is P. So P is the principal or the actual borrowed amount at the beginning of the year, 1 or 0 time. Let's look at another example, and in this case we are borrowing 20,000 for 1 year with 9% interest rate. In this case, the interest rate being given, the original amount, which is P, the principal, being given, and we need to calculate the total amount of money that we need to pay back at the end of the year. So notice that the amount that we are going to borrow, like we said, principal P is equal to 20,000. The interest rate I is 9%, and 9% is 9 over 100, and the number of periods is 1. N is equal to 1 since I'm talking about 1 year. To calculate the interest amount, we multiply the interest rate multiplied by the principal amount multiplied by the number of periods, and that will be 9% times 20,000 times 1. Calculating that will yield 1,800. So the result is $1,800. Based on that, the total amount that should be paid after 1 year is equal to the principal plus the interest amount, which will come up to be $21,800. You can also create an Excel sheet to automatically calculate the interest rate or the total amount to be paid, or even the principal itself. If you don't know how to do that, you can come to my office during office hours and I will be more than glad to help you. All what you need is to insert this formula into the Excel sheet. And like I said, I want you to practice that, see if you can do it yourself. If you cannot do it yourself, just let me know and I can work with you on that. From an investment perspective, if you invested the 20,000 for 1 year with 9% interest rate, then you will be earning 1,800 in that year. Actually, the 9% is called your rate of return on investment. Rate of return. Since you are investing, then this is what you get back. Rate of return, what you get back on the invested money. Another term that is important that you will hear, and it's important to address actually, is inflation. We hear it a lot and we need to know, what does inflation mean? Inflation is defined as the decrease of the currency purchase power, which means that your currency becomes worth less over time. Or in other words, you need more money to buy the same amount of goods or services. The inflation will decrease purchasing power, it will increase the operating cost, and reduces the rate of return on investment. Tax is also another term that you will be using in the economic analysis process. So taxes are defined as involuntary fee imposed on corporation or individuals that is enforced by a level of government in order to finance government activities. So when analyzing projects economically, taxes and the impact of taxes have to be taken into consideration, which will provide a more realistic scenario on what will the actual outcome for the project financial situation will be. If you don't take taxes into consideration, we call it before tax cash flow analysis, and most of the time at the end of the project you have to calculate that tax, and it has to be included. But we can do calculation before tax or calculation after tax, and after tax will give you the realistic economic analysis or the actual numbers that should be should result from a project. To understand the cash flows, we can use the cash flow diagram tool. This tool will assist in identifying inflows and outflows. Inflows is defined as the cash that has been received, and usually that should be positive. Outflows is defined as the cash that was paid out or dispersed, usually in negative. So we have inflows and outflows. We can actually look at the previous example that we did, which is borrowing 20,000, and the 20,000 would be considered as inflows in our pocket. We got that, so it's positive. We borrowed the money, so we have the money now, and that's positive. After 1 year, it has to be paid back, and that will be out of pocket, and that's an outflow. That's why it should be in negative. After knowing some of the terms that can be used in the economic analysis, let us learn about the different methods of calculating economical values based on the interest. We have two kinds of methods of calculation. The first method is using a simple interest during the whole calculation or during our calculation. And in this case, we will be charging interest only to the initial sum or what we called before as principal. In the second method, we call it compound interest. And in this method, we charge interest on the initial sum and to the accumulated interest that has not been withdrawn from the account. To understand, let's look at examples that will represent the simple interest and the compound interest. So for the simple interest, in this example, the principal amount is 1,000, as you can see in the table. So at the beginning of year 1, we borrowed 1,000. The interest rate is 8%, and the number of periods is n equal to 3. So we have 3 years. So let's look at the following simple interest rate example. In this example, the principal amount is 1,000. So P will equal to 1,000. The interest rate I is 8%. So I is equal to 8%. And like we said, 8% is 8 over 100. That's 0.08, and the number of periods n is equal to 3. Since the interest should be charged to the principal amount, which is the 1,000, then the interest for each year will be 80 dollars. So if we multiply 1,000 multiplied by 0.08, that's equal to $80, and that will be the amount that will be charged for every year. So 80 times 3 will equal to 240. Based on that, the total amount that should be paid after 3 years, and we will call it future amount, it should equal to 1,000 plus the 240, and that will equal to 1,240 or 1,240. And this is the total amount that you need to pay back after 3 years using simple interest rate if you borrowed 1,000 as the principal amount. Now, if using the interest rate, the simple interest rate, can we get a formula from that? Looking at the numbers, we can see that F will equal to, and this amount is P, so it will equal to P plus. How did we get the 240? The 240 we got it from the interest rate multiplied by P multiplied by N, the number of periods. So that is how we get the value, and that will be the formula to calculate the total amount that need to be paid after N period of times using simple interest calculation. This is for the simple interest calculations. So for the compound interest, we have to consider not only the initial sum, but also the accumulated interest over the given number of periods. And that's the only difference between the simple and compound. That now we are not taking into consideration just the actual or the original amount that's been borrowed, but also the accumulated over the years. Now let's see how would that work if we took it in a compound interest. It's the same example. The amount that been borrowed is 1,000. The interest rate is 8%. But you know, the first year, as you can see here, 8% of 1,000 is $80. When you add after the first year, you have 1,000 plus 80, then the new amount is 1,080. Now we take the new amount, the 1,080, and find the 8% of that, the 8% of that. So if we use the calculator again, we can see that 1080 times 0.08 is equal to 8640, and this will be the new interest based on the new accumulated number. Again, now we add that to the 1080, and that will equal to 1166 and 40 cents. 1166 and 40 cents. Again, in the third year, now I will not take the 8% on the first or the actual or the 1080. I will take it on the new number, which is the 1166.40. So I will multiply that times the 8%, and that will give me $93.31. So I will add that to the 1166 and 40 cents, and that will equal to 1259 and 71 cents. And this is the total amount that we need to pay back at the end of the period, considering compound interest. And this is the actual calculation that you will see most of the time if you borrowed in a bank, from a bank, or from a financial institution. This is the way that they calculate it. And there are other factors that you will learn later on how to use, which is the inflation and the taxes and other factors that will be included, and it will add to the calculation, or it will be considered in the final calculation of what you need to pay back at the end of the period. So now let's look at this in details, step by step. If we took it the first year, and what we did here, we used the cash flow diagram to show me what's happening every year. And as you can see, at the beginning of the year, times 0, we borrowed 1,000. At the end of that year, we need to return 1080. Now the 1080, which already we have at the end of the first year, or at the end of the first year, will be charged interest rate 8%, and at the end of the second year it will be 1166 and 40 cents. That amount will go to the third year with interest of 8%, and that will take it to the end of third year to be 1259 and 71 cents. So if you look at the compound interest formula, we need a formula for that. How would that formula work if we are using the compound interest rate and we need to calculate the future value based on that compound interest? For year 0, or the initial amount, or let's say at time 0, we can see that the amount will be the principal amount. After the first year, the new value will equal to the principal amount multiplied by 1 plus I. And if you use the calculator again, you will see that 1 plus 0.8 will equal to 1.8 multiplied by 1,000 equal to 1080. And this is the new amount after the first year. Now in the second year, I will use the new future value here, which is F1. I'm using F1 now, which is the 1080, and I will multiply it by 1 plus I. Now remember that F1 is P multiplied by 1 plus I. So if I use this, substituted this value here, then I will get P multiplied by 1 plus I multiplied by 1 plus I, which is P multiplied by 1 plus I squared. 1 plus I squared. And this is the amount. And that's for the second year. Again, maybe it will be easier in the calculator. So you have 1.08, and that's 1 plus 0.08. That's the interest, 1 plus the interest. Now we square it, so it will be squared, and that will equal to 1.1664. Then we multiply that by 1,000, which is P, and that's when we get the 1166 and 40 cents. So the formula actually is Fn, and n is whatever the number of period, will equal to P, the principal amount, multiplied by 1 plus I, the interest rate, to the power n. And this is the formula that we need to use to calculate the future value of a borrowed amount with the interest rate I, and after number of periods n. Let's look at the cash flow diagram for the whole 3 years, and using the formula, the new formula for the compound interest. And you can see that 1,000 borrowed now should be returned after 3 years as $12.59 and 71 cents, considering interest rate of 8%, which means that future value of the principal amount after 3 years will equal to the principal value multiplied by 1 plus the interest rate to the power 3 in this case, and that will be the $12.59 and 71 cents. And again, you can try and create an Excel sheet to do the simple calculation or the compound calculation for you through the different cells and adding this formula into one cell. Next time I will create an Excel sheet and show you, but for now I want you to try it yourself and see if you can do it. That will be all for this session. If you have any questions, you can email me or you can come to my office. I will be more than glad to assist. Thank you and have a great day.